Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Alright, carrying on from our previous video, just a quick recap. We've estimated that there is potentially about $5 billion gross profit from Shanghai and Fremont. Now we have a starting point. We need to add in all the other variables and then find out how much of that $5 billion is left. Firstly, we will add the last element to auto profits, the regulatory credits. Now, every element in this report could have a big effect, and regulatory credits are no exception. Except in Q1, regulatory credits were an exception, as an exceptionally high regulatory credit. We have a credit of $679 million last quarter. This was Tesla's highest ever regulatory credits, and was unexpected. In fact, this was the only ever time the credits were above $500 million, except for Q1 in 2021, when it reached $518 million, i.e. last quarter had regulatory credits over 30% higher than the highest quarter previously. Now, if there was ever a quarter that was in need of some regulatory credit TLC, then this was the one. I'd like to place $500 million in there, but it has rarely even hit $400 million many times. Perhaps it's possible Tesla can put down another $600 million, but judging by history, I think we're possibly still being generous at $400 million, which is what I think I will place. Perhaps a little on the high side, due to last quarter being so high and this quarter needing it so badly. Now, on to what is likely the hardest part of this to calculate, the Texas and Berlin money furnaces. I'm not sure what others are estimating, but I think an average of $200 million loss per factory is probably over budgeting. I've been through the numbers, and I would have a hard time to believe that it would be over $400 million total loss for those new factories. I think the number may actually be closer to $300 million, but I'm trying to work hard getting a good result without having to be overly bullish. For the record, I didn't just pull these numbers for the factories out of thin air. We've done a full model in a past video as to what these factories might have cost during Q2. And despite Elon saying they were costing billions, those numbers don't stack up unless he was talking about construction costs or lost opportunity costs. I would guess that this is potentially where the other estimates are likely to differ the most. Now we've added regulatory credits in the factories, well, I'm happy to report that we're now at a total auto gross profit of $5 billion. That is not nothing. In fact, it's only $550 million less than last quarter. Remember, Zach Kirkhorn said that the increased margins might offset the two new factories. Of course, this was before the China lockdowns and likely the 4680 struggles. Either way, he seems to think that there is going to be a lot of extra profit from the price rises. As for the other operations of Tesla, it would appear services and other did well last quarter, and perhaps now with Tesla's leases expiring, then Tesla are able to resell those used Teslas. And let's face the very real possibility that Tesla possibly made a Model 3 in 2019, received 3 years leasing income, and now Tesla are possibly able to resell this 3-year-old Tesla for more than it cost back in 2019, and with the additional leasing profits too. That's pretty impressive. Energy has also been growing a bit lately too. Q1 saw some good numbers, however still losses, but perhaps Tesla are making less losses now, using more LFP cells and storage. With all that said, I'm going to estimate $0 profit. Hopefully it's that high, and Tesla haven't ramped up more losses by expanding energy. These areas of business are not going to have any major impact for some time anyway. Sometime in the second half of the decade perhaps. Alright, that brings total gross profit to obviously exactly the same. And I'm sure you guessed what was coming up next. We can't neglect our old friend Bitcoin. Now, I think it was Elon who hinted that Tesla were holding close to 42,000 Bitcoin. I have Tesla's last Bitcoin impairment at $31,576 and the new low of $17,601. Yes, Bitcoin got that low, resulting in an additional impairment for Q2 of $586 million. Ouch. That is definitely going to be felt in the earnings, one way or another. I think we placed Bitcoin impairments in OPEX under restructuring and other. Now, there is another potential restructure this quarter, which could be moving headquarters to Texas. That is tough to guess, but I'm going to increase restructuring to $650 million, including Bitcoin, in case there are some costs there, like severance pay, as Tesla have also been making layoffs in Q2. As for the rest of the OPEX, well, this is where it gets interesting too. Last quarter, we had our highest ever expense in R&D, and I'm not sure if this is a one-off event, or if it's possibly going to increase even further. The most expensive part of Tesla's R&D is their FSD, so perhaps there is more to spend on R&D as we're approaching human-level FSD. Actually, that's a thought. All other EVs are struggling so much to make a profit, partly because their OPEX is so high, significantly higher than Tesla's was at any equivalent stage, but most of Tesla's R&D expenses were FSD, so where are the likes of Polestar's equivalent R&D dollars going? Anyway, I do think that the chances are that the last quarter's R&D was likely high, and this quarter's may not be, but it still could be high. So I'm going to place $750 million in for R&D. This is still $115 million less than last quarter. Now, there is a chance this could be as much as $250 million less as well. There's also a chance it could be $100 more. It's definitely on the high side, but might be what Tesla is spending now. SG&A is going to be another fun one this quarter. Tesla do have layoffs. If Tesla had to pay severance pay due to their layoffs, then that would have been included in our restructuring. But there may be less wages, and potentially the new HQ has lower overheads in Texas compared to Silicon Valley. I'm going to keep it about where it's been over the last year, at around $1 billion. No joke, SG&A was still that much around mid-2020. You see, this is pretty much a fixed cost, and once you've covered it with high enough margins, and the rest of OPEX, then it's all profit from there. Yet Tesla are producing 4 times as many cars since then. SG&A up 10%, production up 400%. Do you see what I mean? Economies of scale. Alright, this brings us to a total OPEX of $2.4 billion. Ouch. That is pretty big. Let's hope there's still some decent profit left. This leaves us with an operational profit of $3 billion. Alright, that's not so bad. We're down $600 million from the previous quarter. And I'm going to go with the same tax rate as last quarter, although I have a feeling that this might be a little bit lower. When we calculate all of that, we come to a net income, GAAP earnings of $2.7 billion. Actually only $500 million lower than Q1. Wow. Well, $500 million is about the Bitcoin impairment, and perhaps the increased prices have compensated for the rest of the discrepancies. This comes to a GAAP earnings EPS of $2.38, and a non-GAAP earnings EPS of $2.72. Okay, I didn't expect it to be this high. It feels a bit too high, but I don't think I have any errors, and have got the numbers too far from the actual numbers. In fact, I have a theory as to why it is so high. I even reported the theory in a recent video building up to this that I discovered. The video discovered that if Tesla raised their prices 10%, it would increase their profits by 50%. Well, we've been seeing price rises. Okay, perhaps cost rises too, but this model is comparing costs from the previous quarter. I'm not sure costs would have risen that dramatically over a quarter. However, I may be wrong, so I'd also like to do another bear model for this quarter. That will be interesting, to see if EPS can realistically get below $2. I don't think I need to make a bull case for Q2, as I'm guessing this might have been more bullish than most expected. I mean, there were 70,000 fewer vehicles from Shanghai produced this quarter. This is quite significant. They do have good margins too. However, they also have a lower ASP and lower adoption of FSD, so perhaps the increased margins elsewhere have offset some of this loss. I'm actually really happy with this model, as I should be, as it was a lot of work. I think that it's all as accurate as I could get, even if it is, however, leaning overly bullish when compared to every other single estimate out there. But yeah, even if I'm somewhat off, I've at least shown the potential for a better Q2 than most people expect, so at least there's some hope. I'm also not sure how many people went this thorough either, so we do have a good chance, and I'm going to certainly put my money where my mouth is. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.